So let's be honest, for those who know something about smart money, when you try to apply it on the first time, probably something like this happens. If you are familiarized with the term order block, you probably try to select the current one and fail over and over again. In this video and the next one, I'm going to help you find which one is going to hold and how to use it. Welcome back to your smart money source. Let's start with the famous ICT order block. Basically, smart money, as I mentioned earlier on my previous videos, they need to accumulate in a tight area of consolidation where they will start manipulating to the upside and to the downside. In this constant manipulation where they take out early buyers and sellers, they are accumulating buy or sell orders. We don't know that until the move is starting, okay? How we can identify order blocks? The best way to do so is identifying levels where smart money has manipulated and taken out liquidity recently. So if we look at this example right here, you can see that the buy side liquidity has been taken here with this up move. So we could potentially call this an order block, but then later price comes back up again with this move. So now that this move took out the previous liquidity, we could call this an order block again. But what's happening? Price is coming back up again. So this is the manipulation that is happening on a tight range. So we cannot know for sure which is the order block until we get out of that consolidation. So basically, after price displaced, okay, and that by displaced I mean big candles coming into one side. Basically, when smart money decides to market execute and push price to a certain direction. So what you need to know and understand is that an order block is exactly that, a level where smart money has been accumulating orders over and over again. So once price starts displacing away from that order block, that's when our possibility of entry comes into play. Why? Let's say if we look at this price action right here, we can clearly see that this up move here, all these candles going higher, took out this previous liquidity here, okay? So this was a stop hand because then later price displaced to the downside, breaking this consolidation and this structure, okay? So once we have this break of market structure, as I mentioned on other videos, we have the direction. Of course, there are a lot of tips and things to take into consideration to avoid entering on a potential stop hand. It might happen that price comes back up again and stops you out before going into the desired direction. But I will explain that on more refinements on coming videos so you don't get stopped so often and you refine your edge into the market using these concepts. But for now, you have to understand that after the break of market structure, we have the direction. What happens when price comes near this zone where smart money pushed price and then reversed? What is smart money doing with this up move? They want to sell, okay, because then later price continue going lower. They actually want to sell, but in order to sell, they need to capture as much liquidity as possible. So we have 50 million buy stops above this high. Smart money is going to buy here, let's say 10 million orders. So they are longing from this level up to here 10 million. What happens when price get to this level, to this high and this space above this high? All the buy stops, all the orders that were pending above this high are getting triggered at the same time. And what is happening? All those orders that got triggered, someone needs to be selling all these orders. And that someone is smart money. So they buy on purpose to capture the buy stops here so they are able to open the same amount of shorts and even more. Because they want to drive price lower and displace to the downside, breaking the structure and continue the downtrend that we were in on a higher time frame. So basically this is a reversal, but this reversal happens on every time frame. If you look at lower time frame, you can see we have a lot of reversal. Even on being on a downtrend, you will see a stop hand going lower, grabbing the liquidity. You can see in this case we grab the liquidity of this all high, sorry, of this all low, and then price reverse to go after the buy side liquidity of the previous move. And in this move to the downside, we have buy side liquidity of these highs, and we have again this up move here that took out previous highs. So this move itself is an order block. So let's go back to this example. Once they grabbed all the liquidity, all these buy stops, and they push price lower, we know now that they have 10 million longs open on this move and 50 million shorts open on this move down. So once price starts going lower, these 10 million longs are going to be in a drawdown, and they don't want to have, of course, a red book. They want to maintain a clean book where they are always profitable, or at least try to. They are always edging, so not every time they are going to be in profit, but when they are not in profit, usually what happens is that price will come back to this level where they initially bought from, and they will start closing these long positions that they use to grab the liquidity. So that's what is called mitigation. The fact of closing the longs that they previously used to manipulate. So once they start closing over and over again in this area, that's when they are ready to continue the down move, to continue being in profit from these orders and new orders that they probably open here. Okay, so that's basically the idea of how these order blocks work. What is the problem? When these order blocks are not going to be working, they are not going to be working when the order flow is bullish. So how do we know if the order flow is bullish or bearish? Basically, as if you watch my previous video, every time we take a sell side liquidity on a given time frame, price is going to reverse and go after the buy side liquidity. But it's not easy because it comes with a lot of manipulation. Every time we grab, it's not easy like this when we have one move and then reverse. Usually what happens is that price will reaccumulate orders, manipulating, making fake moves to the downside, making people think that price will continue going lower and then quickly reverse. You can see that that actually happened prior to this down move here, where price was in a consolidation level, accumulating orders over and over again. They stop hunting and then quickly reverse to go after all the liquidity, as I mentioned earlier. So the order flow in this case, we are looking at EURUSD, was bearish because we came from a bearish structure on the higher time frame. The higher time frame is always going to give you the correct order flow or what price is doing. So if we're looking at the 1 hour chart and we are approaching a daily level where we assume that smart money previously accumulated orders from, we know we have to understand that if we are on a downtrend and we have lowest objectives to be met in terms of liquidity, price is likely to respect this level and then reverse. And that reversal will happen from the 1 minute chart to the 1 hour, 4 hour, until the daily completely reverse and breaks the structure to the downside one more time like it did here. Here we have an example of how you could have mistakenly taken this trade here. For example, you can see that we are on a range since price started making this accumulation here. We have all this down move, then we have this push up. This move up is the one that will get you stopped because you think, okay, this is a move to the upside. We broke the structure here. So now that we broke the structure after taking liquidity here, because price went lower than the previous days or this all low, grabbing the liquidity, you will probably think that price is ready to go higher. The problem is that in order to avoid getting into this buy, because this you can clearly see we have a stop hand here grabbing liquidity and price then displays, this order block will not hold. And the reason is that if we look at a higher time frame, this move here, when price started moving like this on a consolidated range, this is an accumulation schematic starting. So how can we say that this is a real break or market structure? When this trading range, we will see this on next videos, is actually broken, and that happened with this move here. You can see that after breaking this trading range, basically this highs here, after breaking, price respected the previous order block, which was this one right here. You can see we have a clear move to the downside, grabbing liquidity, and then price displacing and breaking the structure to the upside. Price respected, making the backup or test of this accumulation, and then went higher. But what happened? This move to the upside, which came from this accumulation, wasn't the objective of this move was only up here. And what do we have here? Look at this. What is this whole move to the upside? This is the order block that we were looking at earlier. The thing is that we were looking at this order block, but this itself is another stop hand of this previous range. You can see we have equal highs being formed, this massive move to the upside, which is the order block grabbing the liquidity and then quickly reversing. So price came back up to this level one more time, and as the order flow or the trend is bearish, price reversed, and this was another distribution schematic playing out here. Drop a like and subscribe if you don't want to miss my next video on how to select the correct order block and avoid the ones that are not going to hold. To understand these concepts, we can say that there are two types of move in the market. There is an efficient type of move where price is coming back and forward and the wicks of each one of these candles are touching each other, and an inefficient way of moving where price moves like this, leaving behind an enormous or big spread candles follow each other where the wicks are not touching each other. Okay, so the market needs to rebalance. When this happens, this means that we have a buy side imbalance and sell side inefficiency. So price needs to come back in the future at these levels to fill that imbalance, because markets need to rebalance itself over and over again to avoid leaving behind these liquidity gaps or liquidity voids. So how can we spot this in the chart? If we look at this price action right here, we can see that on all these candles, we have followed candle, consecutive candles without the wicks touching each other. That's a liquidity void, the void between the wicks. So all this from this wick right here where it starts, we have a void until that wick, we have another void until that wick, and we have another void until that wick. So how can we use these imbalances or liquidity voids? We can use them as targets or as confluence to take trades, because when price comes to these levels, usually that rebalance that price does when sellers come into play, when price comes back into this level, is probably going to give you some kind of mitigation that will make price bounce off these specific levels. Usually when it touches the start of this imbalance, you will have a bounce, in this case to the upside, because price was willing to go higher. Sometimes it will fill 50% of this entire range around here, and sometimes it will completely fill it and even go lower. That will depend on the previous structure that we have here. That's the most important thing. In this case, for example, now that we're talking about this structure, we can see that all this move to the downside that began right here, this is an order block. Once this order block was broken right here, price came back, tested the start of it, and then continue going higher. So how can we apply this into order blocks? If we have an order block where we are seeing that price is likely to respect, because we are analyzing the market structure and the order flow, and all indicates that a specific order block is going to be respected, what we can do is look for unmitigated areas of these order blocks. You can see that this order block was broken with this wick here. After this wick broke this low here, which is the start of the order block, price came back up into the middle of this order block right here. You can see around 50% of this up move is where price stopped and then continue going lower. And you can see that inside of this price action, what did we have here? We have a tiny little imbalance or void between this wick right here and this wick right here. You can see that after filling that imbalance into this order block, price then later continue going lower. If we look at lower time frames, probably inside of this structure, we will have different order blocks coming higher and taking out. Even this week on a lower time frame is probably an order block, and you can see how it was mitigated by this other week after breaking the low here. But the thing is that we can see that there is no inefficiency or void whatsoever inside of this structure, because the only void that was filled by this move, and then price continuing lower. So we can say that up to this level, this order block was already mitigated. So we can look for buys inside of this last move here, because it's part of the original order block. You can say that this up move here is an order block because it grabbed liquidity, taking out this high and then reverse. You can say that yes, but it's always best to work with the original order block. You will often see once you start backtesting these theories that when there is an order block being formed and then price continues the market structure, every time price tries to hit this order block, it will do so in some specific level of this order block, either this candle right here, 50% of the entire move, or the start of it right here. Sometimes you can confuse yourself and try to trade off of this order block, but the most important area is this one. Price could easily come back up here, taking out this high and then reversing because it's respecting this order block. So what you need to do is, the best way to avoid getting stopped is looking at these inefficiencies on lower time frames, more importantly, and looking where price is inefficient and where there needs to be a rebalance. So remember, this void or this imbalance are like magnets for price, because the gaps that they leave of liquidity, they need to be balanced. They will not, like I said before, they will not always be rebalanced, but most of the time they will. So it's better to trade using those type of imbalance as confluence when looking at an order block. So in this case, this imbalance was filled, price continued going lower. We can see that here we have a massive void to the downside here. And above this void, what do we have? This massive wick to the upside. You can see that this up move, like I mentioned before, mitigated this order block, and now this up move here mitigated this up move here. Remember, every time price is moving higher, smart money is accumulating orders, in this case to the downside. So basically we have bearish order flow. So we have two options here. We can look for engulfing moves, because the engulfing moves with these big spread candles are made only by smart money. Retailers cannot do this. So if we know for sure, or we have a high we really think that price is going to continue the downtrend, every time we see a down move like this, in this case, it means that smart money is involved in this move and they are selling in market execution. That's why price is moving with speed and magnitude to the downside. So if smart money is selling here, what was the last order block before that selling pressure where smart money accumulated and stop hunted? In this case, we already saw this one and now this one inside of this void. So we can select the previous candle of this imbalance or of this engulfing candle, which in this case would be this one on the 1 hour chart, and we can use this candle instead to enter a trade in the future. You can see that in this case, price touched this level and then continue going lower. And the reason is, one more time, if they are accumulating orders and they have a lot of short orders open here, they won't allow price to go in drawdown if they are already selling into the market. Price will respect that level and continue going lower. So you can use that to refine the order blocks and enter with tight stop losses. So let's look at this current chart to try to analyze and refine the order block. We can see how we come from a downtrend, price is making lower lows, lower highs, lower lows, lower high. Is there a way to capture this high here with high precision and with a very tight stop loss? Yes, there is, and I will show you how. If we look here, we have a distribution here going out, playing out here, taking out liquidity. This is the last top hand, or maybe the uptrust after distribution, or test, because we have a higher high here, and then continuation to the downside. What we can see here is that this was the last bit of manipulation that price action did. Went lower, grabbing all the liquidity below these equal lows. After grabbing that liquidity, all the breakout traders that were selling here, they were placing a stop loss on this high here, and that's where price exactly went to, took out these highs, these relatively equal highs, and then price continuing higher. So we can say that this up move here, this entire up move is the order block. So now let's go to a lower time frame. Let's go to the 30-minute chart. Now inside of the 30-minute chart, we can see that when price was approaching this level, we have a tiny little indecision candle right there, and then price did this up move, taking out the liquidity. So we can refine this to be the order block right here. You can see that after this order block was created, price then was mitigating it over and over again. After breaking its low, which is here, price came inside of this range and then started mitigating over and over and over again. So let's go to a lower time frame, to a 50-minute chart. Inside of the 50-minute chart, again, we can see that the last move that grabbed liquidity, which had the intention to go higher, was, again, we can pretty much say that from this candle, these two candles are part of the same order block, so we can say that still these are the order blocks. So now let's see on the 5-minute chart, and we can leave it right there as the maximum refinement. Let's look where price is being inefficient and needs rebalancing. So let's look at all this price action. Do we see any void between the wicks, any imbalance? Yes, there are some, but they were already filled. For example, we have an imbalance or void between this wick and this wick here. You can see next candle goes up, fills all the imbalance, so that's already filled. We have an imbalance here. We can see a lot of voids between the wicks here, but then later price comes back in, rebalanced all that price action, always mitigating the same order block, remember that, and then price continues going lower. Here we have an imbalance from this wick right here to this one right here. And we can see that that imbalance was almost completely filled, but there is a tiny little space that was not mitigated. And this space is inside of the range of this original order block, which is the root or the origin of all this move here. So this level right here is the level that we will look for potential sell opportunity or shorts, because this is the last imbalance inside all this price action. We can see that even here, what it may seem to be imbalance or void, it is all pretty much efficient price action, because price comes back and forward, feeling all the wicks are touching each other. So the only bit of imbalance was this one, and if we move this rectangle to the right, you can see later when price was coming back into that level, price touched that imbalance inside of the order block. Remember, is the only one there was, and then from that level, boom, we have a move to the downside. How can we be sure to take this trade, and how can we place a stop loss? Well, you can either take an entry with a sell limit. You can see that if we use the refined method of choosing this order block, we can see that all this up move inside of this structure was an order block, because we have equal highs here, price went higher, inducing new buyers, and then quickly reverse. So this is the order block. We have an engulfing candle with an imbalance, which is this one right here, going lower, displacing and moving forward to the downside. So we can use this candle as our reference to move the stop loss and above this level, because it is the previous candle before the displacement started. So if we use that as our stop loss and the void as our entry, you can see how you could have had a very good setup on this shorting opportunity on EURUSD. Okay, so how to refine again? You go from a higher time frame. If we are looking at the daily chart, then you have to start with the daily. If we are looking at the 4-hour market structure, of course, start from the 4-hour. It doesn't matter. It depends on which market structure you are looking at. Again, if we are on a swing high from the daily chart, then obviously you need to start on the daily chart.